many African countries have inherited systems from the West. Many of our countries are reliant on people outside their own country or outside the continent even to provide funding. We tend to be recipients of whatever it is that they are willing to give. We become price takers. We really need to be much more imaginative, much bolder in terms of setting our objectives over the next 20 to 30 years.
Hello everyone, welcome to Development Reimagined, easy to digest video and podcast series Africa Unconstrained, supported by Quartz Africa, an essential online source for understanding the forces shaping our world. Our aim with Africa Unconstrained is to explore African perspectives on the continent's new era, especially in the context of a post-COVID-19 world. If you don't already know Development Reimagined, we are a leading independent and African-led international development consultancy with our headquarters in China and with offices in Kenya and the UK. Our mission is to provide new ideas and solutions to deal with the complexity of global poverty and climate change. And it's a mission our diverse team strives for daily. I'm Ovigwe Eguegu, and without further ado, for this session, I'm very excited to be here with our distinguished guest, Andrew Alli, to help reveal his unique perspective on Africa's 55 varied economies and how to protect and revitalize their growth in a COVID-19 context and possibly with China. Andrew Alli is a finance professional with over 30 years of experience. He is the CEO of SouthBridge Group, a Pan-African investment bank. Prior to this, he was the president and CEO of the African Finance Corporation, a multilateral financial institution focused on improving Africa's critical infrastructure. Now, Andrew, I want us to start off our conversation with a number. If there was one number you think every African should be aware of with regards to Africa's economies in a post-COVID-19 context, what would it be and why?
Hi, Ovigwe. Good to meet you, and thanks for interviewing me. The number that comes to my mind is 15 million. That's the number of new people entering the workforce every year across Africa, and therefore the number of new jobs that need to be provided by African governments or in Africa just to keep the employment situation where it is today. This is part of a wider population growth statistic, which is that the population of Africa on current trends is due to increase from about 1 billion today to about 2.4 billion in 2050. That's in just 30 years' time. And our continent has to get ready. This is obviously assuming birth rates don't fall, but even if they do, we're still already locked into a very sharp increase in population. So not only jobs, but also infrastructure to support that level of population growth. And this is hard infrastructure from power, roads, housing, through to softer infrastructure like healthcare, education, social security. All those things need to be boosted, and we don't have much time to do it. So as part of this, we have to rethink, or to use your terminology, reimagine how we're looking at the industrialization of Africa. Technology is meaning that you need even fewer people to produce the same goods as you did in the past, and therefore and that's why you're seeing what's called reshoring, where manufacturing that left, say, the US to go to East Asia because of cheap labor is now actually going back to the US because with automation you don't need the labor or as much labor anymore. We need to think about what industrialization in the 21st century means. And to me, that means looking for other areas where you can, and if you think about what manufacturing does for an economy, especially export-led, right? It sort of puts you into an internationally tradable market, which forces you to compete, it forces you to innovate, it forces you to be amongst the best in the world. That drives up your own worker productivity. And really, at the end of the day, you can only increase how wealthy you are as a country if your average worker's productivity goes up. It also means that you have to, be continuously learning and improving, which also means that your productivity continues to move up the curve and catch up to some extent with what's abroad. Now, when you look at that, I think that people need to look at how you can start to trade services. So, the internet allows us to be sitting in Lagos, which is where I am today, and, communicating with people in Abuja or China or wherever. And this has allowed people to start to sell their services over the net. So that is certainly one aspect that they can do. There are other things that also bring in sort of international tradability, but which are not so big in Asia. So agro-processing could be one, tourism could be another, financial services and trading within Africa as opposed to outside Africa could be another. And of course, the AFCTA is a good avenue to get that last point going. But my fundamental point is that we really need to be much more imaginative, much bolder in terms of setting our objectives over the next 20 to 30 years to accommodate this wave of people coming into our workforce.
Thank you, and yes, that's a perfect number to kick off our discussion today. We know that every African country has a different history, a different debt profile, and financial needs going forward. Nevertheless, let's see if we can explore and reveal an African perspective on debt a bit more. My question is, are there any long-term solutions to financing deficits in Africa whilst avoiding debt distress?
So this actually in a way ties in with the last question that I answered. In order to push the various sectors and the sort of the 21st century industrialization that I was talking about, African governments need to invest in things like infrastructure, education, because you need to educate your workforce to the point where it can become globally competitive, as well as providing healthcare and other services to this growing population that I was talking about. And as we've seen, many African countries are already running deficits without these investments. And again, when you look at numbers provided by the African Development Bank, for example, they talk about an infrastructure investment deficit in excess of $100 billion per annum. And that's just to catch up your infrastructure to where it should be. So borrowing and deficits is something that I think could be on the scene for quite a while. And it's important for governments to really think very hard about this. Of course, the best way of managing your deficit and avoiding debt distress is really to reduce the deficit. So I think that's the first step, and that's one thing that I often see countries not doing, is really how to manage their deficit. How do you manage your spending? It's not that you necessarily have to cut your spending, but you need to make sure that the spending that you do make, especially the deficit spending, is an investment that it actually drives your GDP growth at a rate higher than interest rates you're paying on those debts. If not, then your debts will continue to accumulate and could eventually cause debt distress. So the first thing is really to think about what you're spending on. Is it as efficient as you can be? Are you spending on unnecessary things? The things you are spending on, especially your deficit, is it actually, are they actually things which are driving productivity and productive growth? So I think that's the first thing. The second thing is really then to look at the source of income. So again, many African countries have inherited systems from the West, whether it's from their former colonial powers or just ideas that have been taken from the West. So, for example, the tax systems in many countries is largely a direct tax system where people are paying income taxes, etc. Now, this works very well in a society where most of the economy is formal, but in our countries, a large proportion of the economy is informal. In some estimates, up to 50% of economic activity takes place in the informal economy. And therefore, systems like, pay as you earn type tax systems for personal income tax collection and corporate taxes for corporate income tax collection are not really touching a lot of the population. Now, a lot of our populations live in poverty and probably can't pay taxes or any significant amounts of taxes, but there are quite a lot of people in the informal sector who do earn quite a bit. And we need to think about more imaginative ways of taxing so that we can touch these people. Nigeria, where I live, has a tax to GDP ratio of about 6 or 7%. This allegedly is the lowest in the world, and really means that even though we have a debt to GDP ratio of less than 30%, which in normal cases would be regarded as absolutely fine, people are worried about our level of debt sustainability. I don't think we're at a problem point yet, but people are worried because debt service to income ratio is very high, and the number varies, but definitely is somewhere sort of in the 70% plus at this point of time. So in short, we're spending 70% of our government income servicing debt, which is not a good position to be in. So Nigeria is a case in point, but this applies, in many other African countries, that we need to think about widening the tax base. We also need to think about increasing domestic savings. Again, many of our countries are reliant on people outside their own country or outside the continent even to provide funding. This either comes in the form of funding from development partners like the World Bank and the IMF, or it comes from bilateral funding, so China providing funding, or the US or Germany or whomever, or it comes in the form of commercial funding, countries issuing bonds and things like that. But a large part of this, as I said, seems to come from offshore. This means that one, we obviously run foreign currency exposure issues because we have to service these offshore debts in dollars or other currencies. Secondly, it means that we become price takers because we are not setting our own pricing through our own domestic savings. We have to accept the pricing that foreigners put on us, and they often put, very huge Africa risk premiums onto the price of financing that they charge. Now, we can have a long discussion about how valid or not those risk premia are, but it's sure that people who are within a country or in close proximity will have a more refined way of looking at the risks involved in that country than people, living thousands of miles away, maybe relying on international news agencies for their understanding of what's going on. And as you know, news tends to get sensationalized because that's what people watch. So increasing domestic savings is also something that we need to do. Now, this is a lot easier said than done, because how to increase domestic savings is something that that takes a long time, involves some cultural shifts, but also implies that a very strong macroeconomic environment needs to be created, and a very strong business climate and investor-friendly environment needs to be created, because to attract your own domestic investors and to get people to put their funds into the system, especially in Africa, where people tend to be poorer and more vulnerable, you actually need to create a very safe environment for them to do this. They need to earn a rate of interest or a rate of return that is higher than inflation, which means you probably need to fight inflation, because if they're not earning above inflation, essentially the value of their money is declining every year they're saving it, and therefore the incentive to save it is actually much lower. You need to ensure that there are saving products, because just as the people who live in a country or who live close to a country are better able to ascertain the risks and make judgments about them, it also means that they're more knowledgeable about the traps and what isn't working. And so governments need to ensure that they do this, and then it needs to be quite a coordinated program. But if we can do these things, it will mean that we become much more masters of our own fate in terms of our ability to borrow, in terms of our ability to fund, in terms of our ability to invest in the things that we need to invest in over the next few years for the reasons I've said earlier. And this is, of course, not to say that we won't continue to borrow from places like China, the World Bank, IMF, and other bilateral or multilateral lenders, or even go to the commercial markets. But it does help us to generate alternatives, which puts us in a much stronger position when we go and tap into those alternatives to get better pricing and better terms.
So I want to understand your insights on African-China relationship, and again, help reveal a forward-looking African perspective for our viewers and listeners. So my question is, it's a big question. What do you think is the biggest gap in Africa's strategy towards China, and how do you think this gap should be filled in a practical way?
As we've seen over the last few years, although it has attracted its share of controversy, but China has also been very willing to invest in the development of African countries, particularly in the development of large-scale infrastructure projects. For me, I think that what China does is that it provides competition and alternatives to what existed before. And as we're taught in economics, competition is good because it reduces prices and gives consumers more choice. And it's the same in terms of financing. Having said that, I think that one of the problems that I see with the relationship between Africa and African countries with China, and by the way, this issue is not just an issue with China, but is actually an issue in a lot of the relationships offshore with other parties. But I'll talk about China today because that's the question you asked. Is that there's a lack of strategy in the way we interact with this country. So we tend to be recipients of whatever it is that they are willing to give, rather than people who have a strategy and who are looking for what they need, what they have determined they need from the best source, amongst which would be China. So, for example, technology transfer. I mean, it's one thing to build railways or build roads or build hospitals, etc. But in doing that, we need to ensure that we are getting the right technology transfer and the right upgrade of skills for our own people. The second point is that, we need to have our own economic and social development plans, economic and social practices in terms of how we intend to implement those plans. And then we should look around the world for the best provider of whatever it is we need. Very often, people who are investing in us or who are, providing financial support, whether it's multilateral institutions, whether it's countries, are very, what I would call supply driven. So they sit in their capital and decide that, we want to invest in, renewable power or railways or ports in Africa. And then they come to, African countries and say, look, we'll give you X billion to, do a renewable power station, which may be what the country needs, or it may not be what the country needs. But very often when there's money being provided, the countries will accept that. I think it's a lot better if it works the other way around and a country determines that, okay, we need to put a 100 megawatt renewable plant here, and then goes to look for the best option, and that option would include who's supplying the technology, the cost at which the technology is being supplied, the financing that comes with it, and the technology transfer, amongst other things that I mentioned. That source may be China, it may be some other country, but I think that more strategic, proactive approach, determining what your own future should look like in terms that work for you, and going to seek the best solution for that, is probably the best way to manage your relationships, not just with China, but also, as I said, with other countries and other power blocks as well.
Thank you, Andrew, for joining our session. It is very important that our audience understands what an African perspective is on these issues. So we really appreciate you speaking with us today on behalf of our audience, and if they would like to understand your perspective in more depth, what should they turn to?
They can go to my company's website. I work for SouthBridge Group, and the website is www.southbgroup.com. So B like boy. And you can find me on LinkedIn as well. Thank you very much.
Thank you, and thank you to our audience. Please do follow us at www.developmentreimagined.com and on Twitter at DevReimagined, and our partner Quads at www.qz.com/Africa. Thank you all for joining, and see you next time.